Okay, let's unpack this. Imagine you've decided to invest maybe in a growing business through a partnership.
Yeah.
You're excited, right, about the potential. But then pretty quickly you start hearing terms like outside basis, recourse debt, maybe non-liquidating distributions of non-cash property. And suddenly it feels like you need I don't know, a Rosetta Stone just to figure out your own financial stake. And crucially, how it all impacts your taxes. It can feel like wading through thick mud, right?
It really can. It sounds complicated, and honestly, it sometimes is.
Well, that's exactly what we're going to dive into today. We've got a fascinating stack of resources here. I mean, everything from foundational IRS publications, Pub 541, for example, to detailed internal process documents that examiners might use, all focused on this really critical yet often misunderstood piece of the partnership puzzle, a partner's outside basis for tax purposes. So, our core mission in this deep dive is to truly demystify this bedrock concept. We want to illuminate some of those surprising connections and equip you, our listener, with the essential knowledge so you feel genuinely well informed about three key areas. First, how recourse and non recourse debt, and that includes loans from a partner, how that dramatically shapes your basis. Second, the often tricky tax implications of non liquidating distributions of non cash property. That's a mouthful, but important. And third, maybe most importantly, how to meticulously review your basis schedule and all that supporting documentation to make sure it's absolutely accurate.
Yeah, and what's fascinating here is how absolutely foundational this concept of outside basis is. I mean, for any partner, it's central. But like you said, it gets intricate fast. Your outside basis isn't just some, arbitrary number on a balance sheet somewhere. It actually dictates crucial tax outcomes. It directly influences things like how much loss you can deduct or what happens tax-wise when you receive property from the partnership. It's truly a cornerstone for any partner. Think of it like a direct, dynamic link between your personal tax situation and what the partnership is doing financially.
Right. It's like your personal financial scorecard with the IRS for that specific investment.
Exactly. That's a great way to put it.
Absolutely. So, we're going to try and cut through the jargon today, make those surprising connections crystal clear, and hopefully provide you with the tools to confidently navigate the impact of distributions and debt on your partnership basis. And yes, we'll definitely hammer home why ensuring the accuracy of your basis schedule isn't just, good practice. It's really more important than ever for avoiding those unpleasant tax surprises.
Couldn't agree more. Diligence here pays off.
Okay, so let's start at the absolute beginning for our deep dive today. What exactly is a partner's outside basis? And why is it such a profoundly critical concept in this whole world of partnerships and taxes? You mentioned it's foundational, but gets complicated fast. So, what does that mean for someone, let's call her Alex, who just joined a new tech startup partnership?
Right. Good question. Let's use Alex as our example. So for Alex, her outside basis is essentially her tax cost and her partnership interest. Think of it almost like a running ledger, right? A personal account that tracks her investment in the partnership. And it's constantly adjusted over time. It represents everything she's put in, maybe cash, property, could even be the value of services she provided. And then it gets meticulously adjusted for her share of partnership income, losses, any distributions she receives, and, as we'll definitely get into, her share of partnership debt.
Okay, so it's a running total of her investment adjusted up and down. Where does the rule for this come from?
The foundational rule for this calculation comes directly from the Internal Revenue Code. Specifically, it's Section 705. That section is literally titled Determination of Basis of Partnership Interest.
Mm.
So that's the primary guiding principle, the bedrock upon which all these subsequent adjustments are built.
Section 705, got it. So it's her personal tax account for the partnership, tracking her investment. But why should Alex care about this specific number so much? What's the practical, real-world implication for her tax planning? Why track it so carefully?
Why track this so meticulously? Great question. The most immediate and probably the most significant impact for Alex is on loss limitations. So imagine her startup has a tough first year, incurs significant losses, which, happens. Under IRC Section 704, Alex's share of that partnership loss, and this includes both ordinary business losses and capital losses, she can only deduct that loss on her personal tax return up to the amount of her outside basis, and that's measured at the end of the partnership's tax year.
Okay. So if her share of the loss is, say, $50,000, but her basis is only $30,000.
Exactly. She can only deduct $30,000 in that year. Now, the remaining $20,000 isn't just lost forever. That's important. Instead, it's suspended. These suspended losses can then be carried forward indefinitely, actually, to future tax years. They just sort of sit there, patiently waiting until Alex has sufficient basis available again.
How would she get more basis later?
Well, maybe through future contributions she makes, or perhaps her share of partnership income in a good year, or, crucially, an increase in her share of partnership liabilities. This mechanism, the 704D limit, effectively means she can't deduct more losses than she has skin in the game, as they say. It ensures that tax deductions are directly tied to her actual economic investment and risk in the partnership.
Okay, that makes perfect sense. It's a financial gatekeeper for deductions, linking tax benefits to real economic risk. So how does Alex's basis initially get established then? Is it always just about putting in cash, or are there other ways she might build that initial investment number?
Good point. It's not always cash. Well, the most common way for a partner like Alex to establish her initial outside basis is by contributing cash or maybe other property like equipment or a building. It can also be established by contributing services.
Ah, like sweat equity.
Exactly, sweat equity. This is particularly relevant for startups or maybe professional service firms where expertise and time are a huge part of the initial value. Now, the impact on her basis, if services are contributed, it depends crucially on whether she, as the partner, recognizes compensation income for those services.
Okay, so if she gets paid for the services versus just contributing them for an ownership stake.
Sort of. It's about whether she receives a specific type of interest. Specifically, if Alex receives what's called a vested partnership capital interest in exchange for her services, that's considered taxable compensation right then and there. That's under Treasury Regulation 1.7211B1. And interest is considered vested if it's either transferable, meaning she could sell it, or if it's not subject to a substantial risk of forfeiture, like she doesn't lose it if she leaves the company tomorrow.
Okay, vested capital interest for services.
Right. In that scenario, Alex's outside basis is actually increased by the amount of this recognized compensation income. So her hard work and expertise, if it results in this vested capital interest, directly builds her tax basis from day one. It allows her to put more skin in the game for tax purposes, potentially, without a direct cash outlay at that moment.
Interesting. So she pays tax on the value of the interest as income, but that value also becomes her starting basis for that part of her investment.
Precisely. It's a powerful, though sometimes, unexpected way to build that initial basis.
Okay, this next part is where it gets really interesting, I think, and often kind of counterintuitive for many partners like Alex. Let's talk about debt. Partnerships, especially growing ones, they frequently incur debt, right? Bank loans, lines of credit. But it might not be immediately obvious how the partnership's borrowing affects your individual outside basis as a partner. Let's really unpack this, how recourse debt, non-recourse debt, and even specific cases like loans from a partner to the partnership impact basis, because this seems like a huge lever for many businesses.
It absolutely is. That's a critical point to highlight. If we think about the bigger picture for Alex, debt significantly impacts her outside basis, almost always by increasing it. It's honestly one of the most powerful and sometimes overlooked levers for basis adjustments. When the partnership borrows money, essentially Alex's share of that new liability gets added to her outside basis.
Her share, how is that determined?
Well, the allocation rules can get complex, especially between recourse and non-recourse, but the principle is that she takes on a portion of the economic risk associated with that debt. And this increase is clearly laid out in that worksheet for adjusting the basis of a partner's interest in the partnership, which again is actually provided right in the Schedule K1 instructions that partners like Alex receive each year.
Oh,
It's there to help. On that worksheet, there's a whole section just for increases in basis. And it meticulously accounts for the change in a partner's share of liabilities comparing the beginning of the year to the end of the year. It also includes any specific partnership liabilities the partner might personally assume during the year. The total increase in these liabilities directly boosts Alex's basis.
Okay.
And that provides more room for her to deduct losses, as we just discussed. And it also affects how future distributions are taxed, which we'll get to. It's almost like the partnership's debt becomes a sort of phantom contribution for tax basis purposes.
a phantom contribution. I like that because she didn't put in cash, but her risk increased.
Exactly. It reflects that she has more economic risk, and therefore the tax system gives her more basis.
Okay, so if the partnership takes on more debt, Alex's basis generally goes up, which, as we just heard, can be incredibly beneficial for deducting losses. Makes sense. But you hear these terms recourse and non-recourse thrown around a lot in debt discussions. What's the practical difference for Alex, and why does that distinction matter so much for her basis, and particularly for those at-risk rules you mentioned earlier? That sounds like another layer.
Yes, it is another layer, and the type of debt matters profoundly, not just for basis, but especially when considering the at-risk rules. Those are a separate limitation on deducting losses that applies after you clear the basis hurdle.
Okay, so basis first, then at risk.
Correct. So let's break down the debt types. First, recourse debt. This is debt for which one or more partners, or maybe the partnership entity itself, depending on its structure, bear personal liability. If the partnership defaults, the lender can come after a partner's personal assets. They are personally on the hook. For Alex, her share of recourse debt generally increases both her outside basis and her at-risk amount.
Okay, so double benefit there for loss deductions.
Precisely. It's kind of the gold standard for loss deduction purposes because it provides that dual benefit. An example would be, a general business loan where all partners are jointly and severally liable. Alex's portion of that liability would be recourse.
Makes sense. What about non-recourse?
Right. Non-recourse debt is different. This is debt where no one is personally liable for repayment beyond the asset securing the loan. The lender's recourse, their ability to recover funds, is typically limited to specific property that secures the debt, like a building or a large piece of equipment. If the property's value isn't enough to cover the debt upon default, the lender generally can't pursue the partner's other personal assets.
So less personal risk for the partners. How does that affect basis and at risk?
Well, here's the key difference. While non-recourse debt still generally increases a partner's basis,
Right.
it generally does not increase their at-risk amount.
Ah.
And that can be a critical limitation for actually deducting the losses, even if you have enough basis. Basis gets you in the door, at risk lets you sit down, so to speak.
So you could have basis from non-recourse debt, but still not be able to deduct the loss because you're not at risk.
That's exactly right. It happens quite often. But there's an important exception.
Okay.
It's called qualified non-recourse financing. This is a crucial and often misunderstood exception within the non-recourse category. It's particularly significant for activities involving holding real property. While general non-recourse debt doesn't increase your at-risk amount, qualified non-recourse financing is treated as an amount at risk.
Ah, okay. So it acts like recourse debt for the at-risk rules, but only if it qualifies.
Exactly. And to qualify, several strict conditions have to be met. It's not automatic. First, no one can be personally liable for repayment. That's the core non-recourse feature. Second, it must be borrowed exclusively for use in an activity of holding real property. Very specific. Can't be for general working capital. Third, it must be loaned or guaranteed by a federal, state, or local government, or, and this is more common, borrowed from a qualified person.
A qualified person. Who's that?
Good question. The rules define qualified persons explicitly. They are those actively and regularly engaged in the business of lending money. Think commercial banks, credit unions, savings and loan associations, your typical lenders. Importantly, qualified persons generally do not include related parties to the borrower.
Like family members?
Or entities controlled by the borrower, yes. Unless the financing is commercially reasonable and on substantially the same terms as loans involving unrelated persons, that's a high bar. It also generally excludes the seller of the property being financed or someone who receives a fee, like a promoter, related to the investment in the property.
Okay, so it has to be a legitimate arm's-length loan related to real estate from a regular lender, basically.
That's a good summary.
Nah.
And both the partnership and the partner must meet these qualified non-recourse rules for the partner, like Alex, to include her share of it in her at-risk computation. So for Alex, summing up the debt types, recourse debt increases basis and at risk. Regular non-recourse increases basis, but usually not at risk. Qualified non-recourse financing increases basis and is treated as at risk.
That's a really important set of distinctions. It's not just about whether the partnership borrowed money, but the specific nature of that debt and who is ultimately responsible or what property secures it.
Precisely. And especially that qualified non-recourse piece is a very specific carve-out, really designed to encourage real estate investment by allowing at-risk basis for that type of common financing.
Got it. Now, what about that other scenario? When a partner like Alex is the lender, say she makes a loan directly to the partnership, maybe to help with cash flow, does that impact her basis differently than if the partnership borrowed the same amount from a third-party bank? I imagine that changes the dynamic quite a bit.
You're right. It absolutely does change the dynamic, and the rules reflect that. Partner loans are generally treated as a special type of recourse debt for basis purposes.
Yeah.
The general rule, and this makes sense intuitively, is that they're allocated 100% to the lending partner for their outside basis calculation.
100%. Just to the partner who made the loan.
Yes. Why? Because that specific partner, in this case, Alex, bears the ultimate economic risk of loss for that specific liability. If the partnership couldn't pay it back, Alex is the one who suffers the loss directly, not an outside bank. It's her money at risk. So it directly increases her basis, and usually nobody else's for that specific loan.
Okay, that makes sense. Her risk, her basis increase.
Exactly. And the partner's instructions for Schedule K1 also clarify another common scenario, dealing with tiered partnerships. So, if Alex's partnership, let's call it top-tier tech, invested in other partnerships, maybe some subsidiary ventures, what we call lower-tier partnerships, her share of liabilities from those lower-tier partnerships will also generally be included in figuring her adjusted basis in top-tier tech.
So the debt flows up.
It flows up, yes.
Yeah.
Unless those lower-tier liabilities are owed to her partnership, top-tier tech itself, that's a specific exception. But generally, the chain of debt can extend through multiple partnership layers, with all those allocated liabilities ultimately flowing up to impact Alex's individual basis in the top-tier partnership.
Wow. So it really reinforces that idea that your basis is trying to reflect your total economic exposure, even through complex
I have
structures.
a goal.
Okay, so let's try to summarize this crucial debt piece for Alex before we move on. An increase in partnership liabilities, whether it's recourse debt where she or the partnership is personally on the hook,
Hmm.
or that special qualified non-recourse financing that meets the real property criteria,
Right.
or a loan she makes directly to the partnership.
Yes.
All of these directly boost her outside basis. And this increased basis allows for potentially more loss deductions, assuming she meets the at-risk and other rules.
Correct.
And it'll also significantly affect how distributions are taxed down the line, which I think is where we're heading next. It's a huge lever, as you called it, for managing her tax situation as a partner.
Absolutely. Understanding how debt impacts basis is fundamental.
All right, now let's flip to the other side of the coin. Distributions. We've covered how things coming in like contributions, income, and debt generally increase basis, but what happens when things go out? Specifically, when Alex's partnership distributes property that isn't cash. And let's assume it's not winding up the partnership, it's what's called a non-liquidating or sometimes a current distribution. She's staying in the partnership. How does this affect Alex's basis? And what are the potential tax implications? Because this feels like an area where partners, especially if they receive, say, a piece of equipment or land instead of cash, might encounter unexpected tax bills.
You're right to flag this. This is indeed a key area where those meticulous basis calculations become absolutely critical for tax planning. Alex might receive a non-liquidating distribution, a current distribution of cash or property, while she remains a partner in the ongoing partnership. Happens all the time. Now, the general rule, as outlined in IRS Publication 541, the Partnership Guide, is, on the surface, fairly straightforward for property other than money. The basis of property distributed to a partner is its adjusted basis to the partnership immediately before the distribution.
Okay, wait. So if the partnership owned equipment with a tax basis of $10,000, even if it's worth $50,000 now, and they distribute it to Alex, her basis in that equipment starts at $10,000.
Generally, yes. The property essentially carries over its partnership tax basis directly to Alex. It's not usually revalued to fair market value for this purpose at the time of distribution. That's a common misconception that can lead people astray. The partnership's basis carries over.
That's huge. So the built-in gain stays with the property now in Alex's hands. So this distribution of property, it reduces her outside basis in the partnership interest, right?
Yes, absolutely. All distributions reduce basis.
Is there a limit to how much this property distribution can reduce her basis? Could it potentially take her basis negative?
No. And this is a crucial, very strict cap. It's foundational to understanding distributions. The basis of the property in Alex's hands, once she receives it, cannot be more than the adjusted basis of her interest in the partnership itself. And that's after her partnership interest basis is first reduced by any money she might have received in that same transaction.
Okay, so money reduces basis first, then the property distribution reduces it, but only down to zero.
Exactly. The property's basis in her hands gets capped at her remaining outside basis. Let's say Alex's outside basis is $15,000. The partnership distributes that equipment with a $10,000 partnership basis to her and also $8,000 in cash. First, the $8,000 cash reduces her basis from $15,000 down to $7,000. Now, the equipment comes out. Its basis to the partnership was $10,000, but Alex only has $7,000 of basis left. So the equipment's basis in her hands is limited to $7,000. Her outside basis in the partnership becomes zero.
Wow, so the equipment's basis got stepped down from $10,000 to $7,000 because of her basis limitation.
Correct. This rule prevents a partner from ever having a negative outside basis. If we look back at that worksheet for adjusting the basis in Part 1, Section B, decreases, there's a specific line for other property distributed. It clearly shows this as a decrease to basis.
Hmm.
All distributions cash, marketable securities treated as cash, other property, they all decrease basis. The worksheet sums them all up. And then after accounting for any decrease in liabilities too, it calculates your ending basis. And there's usually a note right there. If this calculation results in a negative number, your basis is 0, period.
Okay, basis can't go below 0. But what happens if a distribution would push it below 0? You mentioned gain earlier with cash. Does that apply here too?
Yes, but primarily with cash or things treated like cash. Generally, a partner like Alex recognizes gain on a partnership distribution only to the extent that any money and certain marketable securities that are treated as money for this purpose included in the distribution exceeds the adjusted basis of her interest in the partnership.
So only cash or cash equivalents trigger gain by exceeding basis, not the property itself.
Generally, that's the rule for gain recognition, solely due to exceeding basis. This is spelled out clearly in the K1 instructions, box 19, code A discussion. Any such gain from excess cash is generally treated as a capital gain, as if she sold part of her partnership interest on that date. And she'd report that on Form 8949 and Schedule D on her personal return. So going back to my earlier example, if Alex had a basis of $15,000 and received $20,000 in cash, her basis goes to 0, and she recognizes a $5,000 capital gain. The property distribution didn't trigger that gain, the excess cash did.
But you said generally. Are there exceptions where property distributions can trigger gain, or maybe where the gain isn't capital?
Ah, yes. Good catch. It's not always capital gain, and property can trigger gain in certain circumstances. Remember we talked about unrealized receivables and inventory items?
Mm-hmm. Ordinary income assets.
Right. If cash or property is distributed to Alex in exchange for her giving up part of her interest in the partnership's unrealized receivables or inventory items, sometimes called hot assets, that portion of the distribution can result in ordinary income, not capital gain. This is a complex anti-abuse rule under Section 751. It basically prevents partners from converting potential ordinary income inside the partnership into capital gain via distributions.
Okay, so Section 751 can turn gain ordinary. What about property triggering gain itself, not just cash?
Yes, there's another major way property distributions can trigger gain even if no cash is involved or the cash doesn't exceed basis. This is where Internal Revenue Code Section 737 comes into play. This adds another layer of complexity specifically for property distributions. Section 737 is designed to prevent partners from avoiding tax on gains they brought into the partnership.
How does that work?
Okay, let's say Alex had previously contributed some property, maybe land, to the partnership, and at the time she contributed it, it had built-in gain.
Meaning its fair market value was higher than her tax basis when she put it in.
It's exactly. Let's say she put in land worth $100 K with a $40 K basis. That's $60 K of a built-in gain. Now, if the partnership distributes different property back to Alex within 7 years of her contributing that appreciated land,
Within 7 years. Okay.
then Alex may have to recognize gain under Section 737. This is often called Section 737 gain.
Even if her basis is high enough to absorb the distribution otherwise.
Yes. The gain recognized under this rule is the lesser of two specific amounts. First, the excess distribution. This is calculated as the fair market value, FMV, of the property being distributed to her, excluding any money received, minus her outside basis in the partnership immediately before the distribution, after reducing it for any money received in the same transaction. Second, her net pre-contribution gain. This is the total net built-in gain on all property she contributed within the last 7 years that the partnership still holds. It's essentially the untaxed appreciation she brought into the partnership that hasn't been dealt with yet.
So she recognizes gain equal to the lesser of the value she receives over her basis, or the built-in gain she originally contributed.
That's the essence of it. It forces recognition of that pre-contribution gain if she effectively cashes out that built-in gain by receiving other property within that 7-year window. And importantly, if Alex recognizes gain under Section 737, the partnership gets to increase its basis in the property she originally contributed, the land in our example, by the amount of gain she recognized. This prevents potential double taxation later.
That's complex, but I see the logic preventing partners from swapping appreciated property tax-free using the partnership.
Exactly. Now, one more critical point about property distributions, and it's a common misconception. Generally, a partner does not recognize any loss on a non-liquidating distribution of non-cash property.
No loss recognized, even if the property's value has plummeted.
Correct. Losses are typically only recognized in very specific circumstances during liquidating distributions when the partner is leaving the partnership entirely, and usually only if they receive solely cash, unrealized receivables, and inventory items, and the basis of what they receive is less than their outside basis. So, for current non-liquidating property distributions, gain can be triggered by excess cash, or by a Section 751 for hot assets, or by Section 737 for pre-contribution gain interactions, but generally no loss is recognized by the partner receiving the property.
That's a really key distinction. Gain can pop up in several ways from distributions, especially involving property, but losses on property distributions while staying in the partnership are generally deferred. So, what's the big takeaway then for someone like Alex receiving property from her partnership? What should she absolutely keep top of mind?
It means she needs to know her basis like the back of her hand. That's the recurring theme, isn't it? A distribution, especially of non-cash property, can have immediate, potentially significant, and complex tax consequences that might not be obvious just by looking at the transaction itself. Without that clear picture of her basis and an understanding of these rules like Section 737, Alex could be completely blindsided by a tax liability she didn't anticipate, even if she didn't receive a dime of cash in the distribution.
Right, that free equipment could come with a hefty tax bill attached.
Precisely. It's not just about managing cash flow within the partnership. It's profoundly about managing potential personal tax liabilities. Her basis is the absolute key to predicting and managing those outcomes.
Okay, we've really dug into the what and the how of basis adjustments, especially focusing on those critical impacts from partnership debt, both recourse and non recourse, and these often tricky non liquidating distributions of non cash property. Now, let's shift gears slightly and talk about the how to track it and maybe more importantly, how to verify it. Because for many of us, the actual mechanics of reviewing a partner's basis schedule for tax purposes, looking at that K1 and making sure all the supporting documentation is accurate, well, it can seem pretty daunting. It's one thing to understand the rules we just discussed, but it's another to meticulously apply them to your own numbers and trust the figures you're given.
That's right. And it raises a really important practical question. How reliable are the numbers you receive, say on your Schedule K1, from the partnership? And what proactive steps should you, as the partner, be taking to ensure their accuracy? Historically, this was actually a bigger challenge. Particularly for tax years prior to 2020, partnerships had significant flexibility in how they reported a partner's capital account on Schedule K1, specifically in Section L. They had several options they could choose to use. One, Section 704B, book capital accounts. Remember those? They were designed to reflect each partner's economic share, often using fair market value for property contributions and distributions, with complex adjustments. These often look very different from tax basis.
Right, focused on economics, not tax basis.
Exactly. Two, they could use GAAP generally accepted accounting principles. Again, often different from tax rules. Three, they could use tax basis, which was the ideal for tracking your outside basis, but wasn't always chosen. Or four, they could use other and attach a statement explaining their unique method.
Wow. That sounds like it could lead to a lot of flexibility, sure, but also potentially a lot of confusion for the partner, right? If you were trying to figure out your tax basis from a number calculated on a totally different system like GAAP or 704B book, that seems tough.
It was tough. It often required significant effort, sometimes even reconstructing basis from scratch, because the K1 capital account just wasn't the right starting point for tax basis.
Okay, so has anything changed? Has it gotten any simpler for you, the individual partner like Alex, who's just trying to manage her tax picture accurately?
Yes, significantly. And this is a huge positive development that directly addresses exactly those challenges partners faced. For tax years 2020 and later, with only a few limited exceptions, mainly for very small partnerships, partnerships are now required to report partner capital accounts on the tax stasis method. Both the beginning and ending balances on Schedule K1, Section L, must now generally be reported using tax basis accounting rules.
That sounds like a massive shift, so less guesswork now.
Definitely. It's a monumental shift aimed squarely at standardizing reporting and, ideally, making basis tracking much more straightforward for you as the partner. As one of our source materials highlights, prior to this 2020 change, estimating basis was much less accurate if the partnership did not use the tax basis method for reporting capital accounts. This new requirement aligns the K1 capital account much more directly with your actual outside tax basis for most partners. It makes the verification process potentially much simpler, as the number you see on your K1 should now, in most cases, directly reflect your tax basis.
Okay, that's genuinely helpful. So if Alex is looking at her K-1 from 2020 onwards, she should generally expect to see tax basis reporting in Section L. That's a much better starting point. But even with that standardization, how does she actually review this information? How does she determine its accuracy beyond just glancing at the number and assuming it's right? What's the practical step-by-step process she should follow?
Yeah, assuming it's right is never a good strategy with taxes. She needs to roll up her sleeves, get that K-1, get the instructions, and actually compare the information using that roadmap we keep mentioning, the worksheet for adjusting the basis of a partner's interest in the partnership. That worksheet, found right in the K-1 instructions, is designed to guide her through every single potential adjustment that affects her basis. It's the reconciliation tool.
Okay, so walk us through using that worksheet to verify the K-1.
Sure. It's generally broken into two main parts, increases and decreases, followed by a section for loss limitations. Part I, partner basis, increases. This is where Alex accounts for everything that adds to her basis during the year. She starts with her beginning adjusted basis, which should match the prior year's ending tax basis capital account from the K-1. That's check number one.
Okay, beginning balance check.
Right. Then she adds any new partnership interest she acquired during the year and any contributions of money and the adjusted basis of property she directly put into the partnership. Crucially, as we discussed in detail, she adds her share of the increase in partnership liabilities. The worksheet breaks this down, comparing her share at the end of the year to the beginning, plus any specific liabilities she assumed. This is a major component.
Got it. Contributions and debt increases.
Then she adds all the various income items allocated to her on the K-1, whether they are taxable or tax-exempt. This includes her share of ordinary business income, net rental real estate income, other net rental income, interest, dividends, royalties, net short-term capital gain, net long-term capital gain, net Section 2031 gain, other income. And importantly, even tax-exempt income, like interest from municipal bonds held by the partnership, increases her basis. It wasn't taxed, but it represents economic value she received, so it adds to basis for future calculations.
Okay, all income items, taxable or not.
Correct. Plus a few other less common items like gain recognized on property contributions or excess depletion adjustments. All these things build basis up.
All right, that covers the increases. What about the decreases side?
At partner basis, decreases. This section captures all the reductions to Alex's basis. And this is where those distributions we talked about play a significant role. She'll account for withdrawals, distributions of money, and the adjusted basis, as determined under the rules we discussed, of any property distributed to her. The worksheet typically itemizes this, showing cash, marketable securities, distributions subject to Section 737, that pre-contribution gain rule, and other property. It sums these up as total distributions.
Okay, subtract all distributions.
Right. She also subtracts any decrease in her share of partnership liabilities or any of her personal liabilities that the partnership might have assumed during the year. Debt going down reduces basis.
Makes sense. Increases and decreases mirror each other.
Exactly. Then comes the critical check, the non-negative basis rule.
Yeah.
After adding all the increases and subtracting all the decreases, the worksheet calculates a potential ending basis. If that number is negative,
Basis becomes zero.
basis becomes zero, and the negative amount of the excess distribution is immediately recognized as gain on distributions in excess of basis. There's usually a specific line for that gain calculation right on the worksheet. This is often where unexpected tax hits people if they aren't tracking carefully.
Okay, and the final part of the worksheet.
Part 2, allowable loss and deduction items. This part is essentially applying that IRC 704D basis limitation we started with. It ensures that the total losses and deductions allocated to Alex on her K-1 don't exceed the adjusted basis calculated in Part 1. Here, she'll first account for non-deductible expenses, things like penalties or certain meal expenses that reduce her basis but aren't deductible on her personal return.
They reduce basis even if not deductible.
Yes, because they represent an economic outflow from the partnership related to her share. Then, it lists all the various loss and deduction items from the K-1. Ordinary business loss, rental losses, capital losses, the Section 179 deduction for expensing equipment, charitable contributions, investment interest expense, excess business interest expense, EB, and so on. If her basis calculated before considering these losses is insufficient to cover the total amount of these loss and deduction items,
The excess gets suspended.
exactly. The disallowed losses are suspended and carry forward to future years, typically allocated proportionally among the different types of losses. This section is the final check, making sure she doesn't deduct more than her calculated basis allows for that year.
That's a highly detailed roadmap walking through the worksheet. It really clarifies the process of verifying the K1 numbers. Can you give us that quick, real-world example you mentioned from the source material? Something that perfectly illustrates the critical importance of this review process, especially regarding distributions, and how nasty surprises can arise if you don't do it.
Absolutely. Yeah. And this example really drives the point home. The source material, specifically an LB&I process unit document that's large business and international division guidance for IRS examiners, includes example 2, reconstructing a partner's outside basis. It features a partner named Joe Johnson. Joe joined XYZ Partnership back in 2014. And, like many partners probably do, he didn't diligently track his basis year after year. Maybe he just filed the K-1 numbers or relied on the capital account balance, which, remember, before 2020 might not have been tax basis.
Okay, a common scenario.
Right. Then an IRS audit starts, and it expands to include his 2016 individual tax return. The IRS issues an information document request, an IDR, specifically asking for Joe's outside basis computation for his XYZ interest.
Uh-oh. He probably doesn't have it readily calculated.
Exactly. Since Joe hadn't maintained his own detailed basis schedule, he basically just provided his K-1s from 2014 to 2016 to the auditor. So the auditor then had to reconstruct Joe's basis step by step using the very worksheet method we just walked through.
Okay, what did they find?
Through this meticulous reconstruction, applying all the increases and decreases year by year, it was determined that before Joe received a large $465,000 cash distribution to 2016, his actual tax basis was only $245,000.
Wow, big difference.
Huge difference. And because, as we know, a partner's basis cannot go below zero.
That excess cash distribution triggered gain.
Precisely. The $220,000 difference, that's the $465,000 distribution minus his $245,000 basis, resulted in a capital gain that Joe was legally required to report on his 2016 Form 1040, Schedule D, a gain he likely hadn't reported originally because he didn't know his basis was that low. This perfectly illustrates why accurate tracking and understanding the impact of distributions, especially large ones, are absolutely paramount. Without it, partners like Joe can face significant, completely unexpected tax liabilities, plus potential penalties and interest.
That's a powerful and probably painful example. It really demonstrates the real-world impact of not tracking your basis meticulously. Just relying on the K-1 without verification can be risky. So beyond just the K-1 itself and using this comprehensive worksheet from the instructions, what other documentation should Alex be looking for? Or maybe requesting from her partnership to fully support these numbers and ensure everything ties out and is accurate?
Good question. To truly ensure accuracy and have the backup needed, especially if questions arise later, Alex would ideally want to see several key pieces of documentation from the partnership. First, the partnership's full financial statements are essential, particularly the balance sheet and income statement. They provide the underlying detail for the income, expenses, asset bases, and liability amounts that feed into the K-1 allocation.
Okay, the partnership financials.
Second, loan agreements are critical, especially for verifying the terms of recourse versus non-recourse debt, understanding interest rates, repayment schedules, and, importantly, reviewing how those liabilities are supposed to be allocated among the partners according to the partnership agreement or regulations.
Details on the debt. Makes sense.
Third, for property contributions and distributions, especially if fair market value is used for 704B book capital accounts in prior years, or if Section 737 might be involved, having details on those transactions, maybe even appraisal reports supporting valuations, can be essential to understand the basis adjustments correctly.
Documentation for property movements.
Fourth, any internal partnership records that detailed capital account adjustments can be helpful. This might include schedules attached to the tax return, specific clauses in the partnership agreement governing allocations or distributions, or even detailed internal ledgers if available. And finally, a simple but highly effective check for Alex to do every year is to compare the prior year's ending tax basis capital account reported on her K-1 to the current year's beginning balance on the K-1.
They should match exactly, right?
They should match exactly. If there's any difference, no matter how small, she should immediately request a detailed explanation and supporting documentation from the partnership to understand why. It could be an error or maybe an adjustment she wasn't aware of. This kind of proactive diligence, asking questions and requesting documents, can save a lot of headaches, potential audit issues, and those nasty unexpected tax bills down the line. It's really about being an active participant in managing your own tax situation, not just passively accepting the K-1 numbers.
Right. Take ownership of verifying your basis. Don't just assume the partnership got it perfect.
Great.
Okay, we focused intensely on the mechanics of basis itself. especially how those non-liquidating distributions of non-cash property and the different types of debt impact it, and then the critical role of accuracy and verification. But as you mentioned earlier, the tax world is incredibly interconnected. Everything affects everything else, it seems. Are there other significant factors or related concepts that can influence Alex's basis or maybe her overall tax treatment as a partner that our sources highlight? Perhaps concepts that are closely related or can interact with basis in complex ways.
Yes, absolutely. Basis is foundational, but it doesn't operate in a vacuum. There are several interconnected concepts that are definitely worth noting for a comprehensive understanding, things that layer on top of or interact with the basis rules we've discussed.
Okay, like what?
First, and we touched on this briefly, remember that loss limitations extend beyond just basis. Even if Alex calculates her basis and finds she has plenty of basis to cover a loss allocated to her, she might still be limited by those at-risk rules we discussed with debt,
Right.
or by separate passive activity loss rules. The Schedule K-1 instructions actually explicitly outline these three distinct layers of limitation and the specific order you must apply them. First basis, Section 704D, then at-risks, Section 465, and finally passive activity rules, Section 469.
A three-step hurdle for losses.
Exactly. And for those passive activity rules, Alex's level of involvement, whether she achieves material participation or maybe active participation in rental real estate, can be crucial. It determines whether an activity is considered passive or non-passive for her, which then dictates whether she can deduct losses against other non-passive income, like salary, or only against passive income.
And material participation has specific tests, right? Like hours worked.
Yes, there are 7 quantitative and qualitative tests, like participating more than 500 hours or being the sole participant. For limited partners, the hurdles are generally higher. There are also specific rules for qualifying as a real estate professional, which can allow rental losses to be treated as non-passive. And a slightly lower standard, active participation, might allow some rental loss deduction for moderate income taxpayers, even if passive. It gets complicated, but the point is, basis is just step one for losses.
Got it. Basis, then at risk, then passive activity limits. What else interacts with basis?
Second, let's consider guaranteed payments. These are payments made by the partnership to a partner that are determined without regard to the partnership's income. Think of it like a fixed salary for Alex's services as a manager, or maybe a fixed return paid for the use of capital she loaned or contributed, regardless of whether the partnership actually made a profit that year.
Okay, fixed payments not tied to profits. How do they affect things?
Well, they are generally deductible by the partnership as a business expense, reducing overall partnership income allocated to all partners, and they are treated as ordinary income to the receiving partner, Alex in this case. An interesting specific example from the sources is that premiums for health insurance paid by a partnership on behalf of a partner for services rendered are treated as guaranteed payments. Alex would include that premium amount in her gross income,
Ah,
though
okay.
she might then be able to deduct it elsewhere on her return as self-employed health insurance. So while guaranteed payments directly affect Alex's gross income and overall taxable income, they don't directly increase or decrease her outside basis in the same way contributions, distributions, or debt allocations do. They're treated more like payments to an outside party for tax purposes, even though paid to a partner.
Okay, so they impact her income, but not directly her basis calculation itself. Good distinction. What's next?
Third, be aware of special rules for transactions between the partnership and partners or related parties. The tax code puts these under extra scrutiny to prevent manipulation. If property is sold or exchanged, directly or indirectly, between a partnership and a related person,
Who counts as related?
well, it includes someone who owns, directly or indirectly, more than a 50% interest in the partnership's capital or profits like Alex if she's a majority owner. It also includes transactions between two partnerships where the same persons own more than 50% of both. In these related party transactions, any loss realized might be disallowed for tax purposes.
So you can't just sell a losing asset to your controlled partnership to get a tax deduction.
Basically, yes. Conversely, if a gain is recognized on such a transaction and the property being sold is not a capital asset in the hands of the buyer, for example, if it's inventory or depreciable business property, that gain to be recharacterized from capital gain to ordinary income. These rules prevent related parties from creating artificial losses or converting ordinary income into capital gains through transactions amongst themselves.
Okay, related party rules. Makes sense. What else?
Fourth, and closely related to distributions, are the disguised sale rules. This is a particularly tricky area the IRS watches closely. Let's say Alex contributes property to the partnership, and then Relatively soon after, the partnership distributes different property, or cash, back to Alex. If these two transfers, the contribution and the distribution, happen within 2 years of each other, the regulations create a presumption that this wasn't really a contribution and a distribution.
What is it presumed to be then?
It's presumed to be a taxable sale of the property Alex contributed, from her to the partnership, or maybe a sale of other property from the partnership to her.
Ah, so they look through the form to the substance.
Exactly. Unless the facts and circumstances clearly indicate otherwise, it gets recharacterized from potentially tax-free events, contribution under 721, distribution under 731, into a taxable sale. If the transfers are more than 2 years apart, the presumption flips. It's presumed not to be a sale unless the IRS can show otherwise. This recharacterization can have significant immediate tax consequences, obviously, turning what looked tax-free into a taxable gain. The IRS wants to prevent partners from essentially selling property to a partnership tax-free by disguising it as a contribution followed by a distribution.
Okay, the disguised sale rules. Watch out for contributions and distributions happening close together. Got it. Anything else?
Fifth, remember those allocations to account for built-in gain or loss on contributed property. Section 704C. When property is contributed to a partnership, like Alex's land example, worth $100, basis $40K, the partnership is required to allocate future income, deductions, gains, or losses related to that specific property in a way that accounts for that $60K pre-contribution difference. So if the partnership later sells that land for $110K, the first $60K of taxable gain must be allocated specifically back to Alex. The remaining $10 gain might be split among the partners according to their regular profit sharing.
So the partner who contributed the built-in gain gets taxed on it when it's eventually recognized by the partnership.
Correct. It ensures fairness among the partners and prevents that pre-contribution appreciation or depreciation from being shifted to other partners. This rule, Section 704C, works alongside the basis rules and the 704B economic allocation concepts, even now that K-1s use tax-basis capital accounts.
Okay, that makes sense. One last one.
Yes. Finally, a more specialized but increasingly relevant area is the Section 1061 information. This applies to what are called applicable partnership interests, or APIs.
What are those?
These are interests typically held by individuals who perform substantial services in certain types of investment or development businesses. Think managers in private equity, venture capital, or some real estate funds who receive a carried interest or a share of profits that's disproportionate to their capital contribution. Section 1061 imposes special, stricter rules for these APIs. It can recharacterize certain long-term capital gains, specifically those related to assets held for more than 1 year, but not more than 3 years, as short-term capital gains.
Ah, so it extends the holding period needed for long-term capital gain treatment for these specific types of interests.
Essentially, yes, for certain gains allocated to those service partners. Short-term gains, of course, are taxed at higher ordinary income rates. Partnerships that have APIs are now required to provide specific information and worksheets to the API holders. You might see this on Schedule K1, Box 20, using code AM for Form 10S65. The partner Alex, if she holds such an interest, then uses this information to complete their own calculations and determine if any of their long-term capital gain needs to be reclassified as short-term on their personal return. It's a complex area aimed at carried interests, but it's another layer that interacts with the reporting and ultimate tax treatment for affected partners.
Wow. Okay, so it's really clear that understanding your outside basis is absolutely critical, but it's not a static calculation performed in isolation. It's this dynamic, interconnected process constantly influenced by debt, distributions, the nature of contributed property-related party transactions, passive activity rules, at-risk rules. I mean, the list goes on. Each piece of information, from the details of a loan agreement to how Alex performs her services for a guaranteed payment, can ripple through to her final tax outcome. It truly underscores the complexity and the nuance of partnership taxation.
Couldn't said it better myself.
Yeah.
It's a web of interconnected rules, and basis is right at the center. Hashtag outro.
Wow, we have covered a lot of ground today, seriously.
Sure.
From, the initial creation of your partnership basis, how it gets started, to the ongoing dynamic impacts of debt recourse, non-recourse, qualified non-recourse partner loans.
Yeah, the whole spectrum.
Then navigating the often tricky world of non-liquidating property distribution, sections 737 and 751. And finally, landing on the absolutely critical need for accurate record keeping and that diligent review of your basis schedule and K1. It's truly been a deep dive into the nuances of partnership taxation, focusing on those key areas: Hopefully, we've managed to demystify some of the most intricate parts of this puzzle for you, our listener.
Absolutely. And if we connect this all back to the bigger picture, that significant shift we discussed, the move to required tax basis reporting for capital accounts on K-1 starting in 2020, it really underscores the IRS's push for greater transparency and accuracy in this area. It's designed to make it more straightforward for partners like you to track your basis, which, as we saw with that cautionary Joe Johnson example, is absolutely vital for managing those loss limitations correctly and, maybe more importantly, avoiding unexpected nasty taxable gains on distributions. But while this change is designed to give you a clearer picture directly from the partnership, it definitely doesn't eliminate your personal responsibility as a partner to understand the rules, verify the numbers yourself using that worksheet, and maintain your own records.
That's a great point. The partnership reporting helps, but the buck still stops with you, the taxpayer. So, what does this all mean for you, our well informed listener, as you navigate your own partnership investments? It means that staying on top of your Schedule K1, really understanding its various codes and the new tax basis reporting method, and being proactive in tracking your own basis calculation, especially being mindful of how debt changes and property distributions affect that number throughout the year. Well, it's not just good practice anymore. It's absolutely essential for smart tax planning and, frankly, for avoiding those unwelcome surprises that could significantly impact your financial well being down the road. Knowing your basis is fundamentally knowing your tax health when it comes to that partnership investment.
It really is. And this maybe raises an important question for your own reflection as you listen to this. In this world of, let's face it, increasing financial complexity, how actively are you engaging with the granular details of your investment basis? Are you just relying on the summary reports, maybe the K-1 bottom line? Or could taking a deeper dive into your own basis calculation, perhaps requesting some of that supporting documentation we talked about from the partnership, could that unlock new insights for you? Or maybe help you mitigate future tax challenges that you might not even be aware of yet?
That's a really profound thought to leave our listeners with. Are you just accepting the numbers? Are you actively verifying and understanding them? Something to definitely ponder as you continue your own deep dives into the world of being truly well informed. Thanks so much for joining us for the deep dive.